Good evening. As Monday, April 20th, 2026 began in Asia, financial markets were gripped by unease. Major Asian currencies lost value while the US dollar surged, all triggered by renewed US-Iran tensions. This was a classic example of how global events instantly ripple through financial systems. Investors, sensing rising risk, rushed to the safety of the dollar, abandoning Asian currencies. The US-Iran standoff reignited fears, impacting everything from oil prices to business confidence. The dollar became a fortress, while Asian currencies appeared vulnerable. Traders watched as the yen, Australian dollar, and won all dipped, while the dollar erased recent losses. This was a textbook flight to safety, showing how geopolitics can steer money flows. The story isn't just about numbers, it's about real fears driving economic decisions. To understand this shift, we need to look at the events between the US and Iran and why investors react this way. The world's financial nervous system was on high alert. Let's break down what happened and why it matters. The spark for market jitters. A fresh US-Iran confrontation at sea. The US military fired on and seized an Iranian vessel, escalating a long-simmering conflict. Iran responded by accusing the US of violating a ceasefire and reblockading the Strait of Hormuz, a vital oil route. The strait's closure threatened global energy supplies, sending shockwaves through markets. The ceasefire, set to expire the next day, now seemed meaningless. Investors hate uncertainty, and this standoff created plenty. Would the conflict escalate? Would oil prices spike? No one knew. The looming ceasefire deadline only added pressure. Fears of a wider conflict drove investors to dump riskier assets and seek safety. The result: Asian currencies fell, and the dollar soared. Why does the dollar rise even when the US is at the center of a crisis? The answer: trust and scale. The US dollar is the world's safe haven. Investors trust the US government to pay its debts and value the dollar's global liquidity. Central banks everywhere hold dollars. Most global trade is done in dollars. When fear strikes, investors sell riskier assets and buy dollars or US government bonds. This demand pushes the dollar's value higher. On Monday, the dollar index rose 0.2%, a big move in currency markets. Even as the US faced conflict, its currency was seen as the safest bet. This flight to quality is a familiar pattern in times of geopolitical shock. The dollar's dominance is about reliability, not geography. Investors want out of uncertainty and into stability. That's why, even in a US-centered crisis, the dollar wins. The world's money moved fast, and it moved to the dollar. Safe haven status isn't just a label, it's a reflex in global finance. The dollar's strength told the story of global anxiety. The dollar's surge meant trouble for Asian currencies. Investors sold Asian currencies to buy dollars, pushing the yen, won, and Australian dollar lower. Asia's economies, deeply tied to global trade and energy imports, looked riskier as Middle East tensions rose. The South Korean won dropped 0.6%, the Singapore dollar 0.2%, and the Australian dollar lost ground after a strong run. Even the Indian rupee slipped, staying near record lows. A stronger dollar makes imports like oil pricier, and dollar debts harder to repay. The financial system transmitted the shock instantly. Asia's currencies weakened across the board. This wasn't just about numbers, it was about fear spreading through the global economy. For Asian economies, a rising dollar is a double hit: higher costs and more financial stress. Monday's moves were a warning sign of potential trouble ahead. The world's nervous system had fired off a clear signal. Risk aversion was in full swing. The Chinese yuan stood out by barely moving. Unlike its neighbors, the yuan is tightly managed by China's central bank. On Monday, the People's Bank of China kept interest rates at record lows, signaling a focus on domestic stability. The yuan's value is shaped more by policy than by market panic. Still, it hovered near a 3-year low against the dollar, showing it's not immune to global pressures. The central bank set a stronger-than-expected reference rate, trying to steady the currency. China's approach is a balancing act, supporting exporters while preventing capital flight. The yuan's calm was a product of control, not immunity. The Japanese yen and Australian dollar took divergent paths. The yen, usually a safe haven, actually weakened against the dollar, overshadowed by the dollar's overwhelming appeal. Investors everywhere, including Japan, rushed to the dollar, leaving the yen behind. The yen's slip showed just how powerful the dollar's safe haven status was. The Australian dollar, tied to global growth and commodities, fell as risk aversion took hold. The Aussie had been strong, but fears of disrupted trade and falling demand sent it lower. The AUD-USD pair dropped 0.2%, reversing a 2-year high. The yen and Aussie's moves captured the market's split-fleeing risk, chasing ultimate safety. In turmoil, the dollar outshone even other safe havens. The market's message was clear: safety first, risk last. The US dollar reigned supreme. South Korea, Singapore, and India all felt the dollar's pressure. The won plunged 0.6%, a big move for a single day, reflecting South Korea's vulnerability to trade and oil shocks. Singapore's dollar slipped 0.2%, as its open economy and reliance on imports made it sensitive to global fears. The Indian rupee edged down, staying near record lows, as higher oil prices threatened inflation and trade deficits. All three economies depend on global trade and imported energy, making their currencies look risky. Investors pulled money out, seeking shelter in the dollar. The moves weren't just about numbers, they reflected deep anxiety about the region's exposure. The market's verdict: these currencies were too risky in a storm. The dollar was the safe harbor. The pressure was real, and the message was unmistakable. In times of crisis, capital flees to safety. All eyes turned to the US-Iran ceasefire deadline, set to expire Tuesday. With new clashes already breaking the truce, markets braced for escalation. Hopes for talks were dim, with conflicting signals from Washington and Tehran. Investors watched nervously, knowing a wider conflict could erupt at any moment. Meanwhile, key economic data from the US and Japan loomed, adding to the uncertainty. Strong US retail sales could boost the dollar further. Weak numbers might spark new worries. The week promised volatility, with politics and economics colliding. For investors, navigating the next 48 hours would be a test of nerves. Monday's events proved one thing: fear moves markets fast. The US-Iran clash sent Asian currencies tumbling and the dollar soaring. Oil supply fears and trade worries hit export-driven economies hard. The dollar's strength was a defensive move, a vote for stability over risk. With the ceasefire expiring and talks uncertain, the world watched anxiously. Economic data from the US and Japan would add more twists. For now, uncertainty is the only certainty. The financial world remains on edge, with the dollar likely to stay strong as long as fear persists. Politics and economics are inseparable, and a shock in one can shake the other. The next move? The world is waiting to see which way the coin will land.